One country's currency lost half its value in a single day, sending shockwaves worldwide. This was the brutal reality of the Asian financial crisis in 1997, a devastating period where years of incredible economic growth seemed to disappear overnight. Before this financial storm, much of East Asia experienced what felt like an endless boom. Nations like Thailand, Indonesia, South Korea, Malaysia, and the Philippines boasted impressive annual growth rates, often soaring between 8 and 12% for over a decade. Foreign investors poured billions, even trillions of dollars into these economies, fueling massive expansion in industries like real estate and manufacturing. Many nations kept currencies tightly linked or pegged to the US dollar, giving an illusion of stability. However, beneath this prosperous surface, cracks were forming. Banks made risky loans, often to speculative real estate projects, with little oversight. Corporate debt climbed to unsustainable levels, making these economies incredibly vulnerable. The breaking point arrived in Thailand, where the baht was under severe pressure. Speculators waged massive bets against its fixed exchange rate of roughly 25 baht to $1. The central bank desperately spent its foreign reserves to defend the peg, but the fight was ultimately lost. On July 2nd, 1997, Thailand was forced to float the baht, allowing its value to plummet freely. The currency immediately depreciated by more than 50%, causing widespread panic. This wasn't just a Thai problem. It quickly became a regional contagion. Financial markets across Southeast Asia and beyond began to tumble. Currencies like the Indonesian rupiah, the South Korean won, and the Malaysian ringgit also saw massive devaluations, some losing more than 80% of their value against the dollar. Stock markets crashed, companies went bankrupt, and millions of people lost their jobs. Capital flight was immense, with investors pulling out billions of dollars in a desperate scramble for safety. To stem the bleeding, the International Monetary Fund, or IMF, stepped in, offering massive bailout packages. Thailand received approximately $17.2 billion, Indonesia around $43 billion, and South Korea a staggering $57 billion. These loans came with strict conditions, forcing governments to implement severe austerity measures, raise interest rates, and restructure their banking sectors. Interest rates soared in some places to 25% or higher to stabilize currencies. While these measures were painful, leading to temporary recessions and increased poverty, they laid the groundwork for eventual recovery. Many nations subsequently implemented stronger financial regulations and more transparent economic policies, hoping to prevent such a crisis from ever happening again. The road to recovery was long, taking several years, but the lessons learned fundamentally reshaped economic governance across the region. Millions lost everything in moments. The 1997 Asian financial crisis showed how quickly fortunes can vanish. Following the Thai baht's sudden float and its more than 50% value drop, a terrifying regional contagion began spreading. Financial markets across Southeast Asia and beyond tumbled at an alarming pace. Currencies such as the Indonesian rupiah, the South Korean won, and the Malaysian ringgit experienced massive devaluations. Some of these once vital currencies lost more than 80% of their entire worth against the powerful US dollar. This widespread financial panic led to stock markets crashing spectacularly across nations. Thousands of companies went bankrupt almost overnight, leaving millions of people without jobs and facing extremely uncertain futures. The capital flight was truly immense, with billions of dollars being rapidly pulled out of these struggling economies as nervous investors scrambled desperately for any safe haven they could find. This intense and desperate scramble put even more immense pressure on already fragile financial systems. To try and stop this catastrophic financial bleeding, the International Monetary Fund, known as the IMF, quickly stepped in to offer assistance. They provided huge bailout packages totaling many billions of dollars to the hardest-hit nations. Thailand, for example, received approximately $17.2 billion in absolutely crucial aid. Indonesia was granted a substantial sum of around $43 billion to stabilize its gravely impacted economy. South Korea, a major regional player, needed a truly staggering $57 billion in emergency funds just to survive. These absolutely vital loans, however, came with very strict conditions attached as part of the agreement. Governments were forced to implement severe austerity measures, drastically cutting public spending and government services. They also had to raise interest rates sharply to try and stabilize their rapidly depreciating currencies and restore confidence. In some places, these crucial interest rates soared to an incredible 25%, or even much higher levels, causing immense pain for both businesses and ordinary individuals. Banking sectors across the region also required massive restructuring and much greater oversight to prevent future similar collapses. While these enforced measures were undeniably painful, leading to temporary deep recessions and a dramatic increase in poverty for many families, they were absolutely essential for long-term stability. These harsh but absolutely necessary steps laid the vital groundwork for eventual recovery across the severely devastated region. Many nations subsequently moved to implement stronger financial regulations and far more transparent economic policies. This collective effort was crucial, hoping to prevent such a devastating crisis from ever repeating itself again in the future. The difficult road to full recovery was certainly long, often taking several years for economies to stabilize and grow again. But the severe lessons learned fundamentally reshaped economic governance and financial oversight across the entire region for many decades to come, impacting generations. 25% interest rates crushed everything. This was the brutal reality following the 1997 Asian financial crisis. Governments faced an impossible choice: accept strict terms or collapse entirely. The International Monetary Fund, known as the IMF, imposed harsh austerity measures, demanding deep cuts to public spending and essential services. This meant less money for healthcare, education, and critical infrastructure, impacting millions of ordinary citizens. Thousands more jobs disappeared as businesses could not afford loans at sky-high rates, often 25% or even higher in some nations. Many small and medium-sized enterprises, representing over 80% of employment, simply vanished. Bank closures became daily occurrences, with hundreds of financial institutions deemed insolvent, requiring massive government bailouts or forced mergers. South Korea alone restructured over 300 financial firms. Currency stabilization attempts were painful but utterly necessary. The Indonesian rupiah stabilized after losing over 85% of its value against the US dollar from June 1997 to January 1998, though at immense human cost. This drastic devaluation made imports incredibly expensive, causing inflation to skyrocket. Food prices soared by 30% or even more, pushing millions into absolute poverty. Social unrest became widespread, with protests erupting in several capitals as people struggled desperately to feed families. People living below the poverty line increased by tens of millions across affected countries within a single year. Public debt swelled dramatically as governments absorbed failing banks' losses and took on new IMF loans. Thailand's public debt jumped from under 20% of GDP to over 50% in just 2 years. These severe reforms, however, were not without their long-term purpose. Nations were forced to strengthen banking regulations, create more transparent financial reporting systems, and build larger foreign exchange reserves. South Korea, for instance, accumulated over $100 billion in reserves within 5 years after the crisis. Capital controls were sometimes introduced to prevent future rapid withdrawals of foreign investment. Many countries shifted economic models away from relying heavily on foreign short-term capital to promoting domestic consumption and more stable long-term investment. The recovery was gradual, taking an average of 5 to 7 years for most economies to regain pre-crisis growth trajectories. Millions slowly found new employment, often in reformed industries or export sectors, benefiting from cheaper currencies. Total economic output of Southeast Asia, which had plummeted by over 10%, slowly began to rebound. Trade surpluses started to reappear as exports became more competitive. The region learned that unchecked growth and insufficient oversight could lead to catastrophic consequences. New regional cooperation initiatives were launched, like the ASEAN +3 framework, involving China, Japan, and South Korea, aiming for greater financial stability and mutual support. These profound changes permanently altered the financial landscape of Asia, creating more resilient, but perhaps less adventurous economies. The total cost in terms of lost output and human suffering remains incalculable, but the institutional reforms set a new global standard for financial preparedness.